$10 a week, that is less than 2 cups of coffee. I want to show you exactly what happens when you invest that amount consistently into a dividend portfolio. A rough estimate, not a motivational guess, the actual math year by year. In a few minutes I'll show you the one decision that separates people who actually build wealth from people who stay stuck reading about it forever. This video is for you if you want to start investing but the numbers feel too big. Too far away, too unrealistic for where you are right now. By the end of this video, you will see the exact math of what $10 a week becomes, and why starting small is not a weakness. It is actually the smartest move a beginner can make. At the very end, I will give you a simple tracking sheet framework so you can follow your own portfolio the same way I tracked this one. Quick note before we start, this video is for educational purposes only. I am not a financial advisor. Nothing here is personalized financial advice. Always do your own research before making any investment decision. Here is what we will cover today. First, why $10 a week is a completely legitimate starting point and not just a feel-good myth. Second, the exact math. Year 1 through year 20, real numbers on screen. Third, the 4 decisions that determine whether your $10 a week actually compounds or just sits there doing nothing. Let's get into it. Me start with the concept that makes all of this work. It is called compound growth, and most people have heard of it. But very few people actually understand what it feels like in real numbers. Is the simplest way to think about it. Imagine you have a snowball. You place it at the top of a hill covered in snow. You give it one small push. At the top of the hill, it is tiny. It picks up a little snow, then a little more, then more. By the time it reaches the bottom, it is enormous and you stopped pushing it a long time ago. That is exactly what happens when you invest consistently and reinvest your dividends. Your $10 buys shares. Those shares pay dividends. Those dividends buy more shares. Those shares pay more dividends. The snowball gets bigger on its own. Here is the myth I want to address directly. People believe that starting with a small amount, $10, $20, $50, is pointless, that you need a big lump sum to make any real difference. That belief is wrong. And I can prove it with math. The size of your starting amount matters far less than 2 things: how consistently you invest and how long you stay invested. I will show you exactly why in the numbers coming up. Okay, 4 decisions. These are the 4 things that determine what your $10 a week actually becomes. Decision 1, where you invest it. This is the account you choose, and it matters more than most beginners realize. If you invest your $10 a week inside a Roth IRA, every dollar of growth and every dollar of dividends is completely tax-free. You pay nothing when you withdraw in retirement. If you invest inside a regular taxable brokerage account, you owe taxes on your dividends every single year. Depending on your bracket, that could be 15 to 20% of your dividend income, taken before you can reinvest it. Roth IRA from day one, your compounding is uninterrupted. Every dollar stays working. Taxable account with no plan, you lose a portion of your dividends to taxes every year before they can compound. $10 a week, this difference might feel small in year 1. Over 20 years it is worth thousands of dollars. Decision 2. What you invested in, $10 a week, individual stocks are not practical. Most quality dividend stocks cost $50 to $500 per share. Right tool here is a dividend ETF that offers fractional shares. Platforms like Fidelity and Charles Schwab allow you to buy fractional shares of ETFs. That means you can put your exact $10 to work immediately, no waiting until you can afford a full share. A diversified dividend ETF with fractional shares available. Every $10 goes in immediately and starts compounding. Waiting until you have enough to buy a full share of an individual stock. Your money sits in cash earning almost nothing while you wait. Sitting idle is the silent killer of small portfolio growth. Decision 3, whether you turn on DRIP. We covered DRIP in video 1, but I want to show you in the math exactly what it does to a $10 a week portfolio. DRIP, Dividend Reinvestment Plan, means every dividend you earn automatically buys more shares. With $10 a week, your early dividends will be tiny, maybe 30 cents, maybe $1. Most beginners look at that and think, what is the point of reinvesting 30 cents? Here is the point. It's 30 cents by a fraction of a share. That fraction pays its own dividends. Over years, those tiny reinvestments become a significant portion of your total portfolio value. DRIP on from day 1, every cent works. DRIP off, dividends paid as cash sitting in the account uninvested. You are manually breaking your own compounding cycle. Decision 4, whether you increase your contribution over time. $10 a week is your starting point, not your permanent number. As your income grows, even slightly, increasing your weekly contribution accelerates your snowball dramatically. Going from $10 a week to $20 a week does not just double your contributions. Because of compounding, it more than doubles your long-term result. Start at 10, increase to 15 or 20 as soon as you comfortably can. Even $1 extra a week makes a measurable difference over a decade. Staying at exactly $10 forever because it feels like a system. Contribution rate is the most powerful lever you have. Let me pause here and give you a quick visual summary before we get into the full math. Decision 1, Roth IRA, tax-free compounding. Decision 2, Dividend ETF with fractional shares. Every dollar works immediately. Decision 3, drip on, every dividend reinvested automatically. Decision 4, increase contributions over time, even slowly. These 4 decisions are the entire system. Everything else is just details. Okay, now the math. This is what I actually tracked. Starting amount, $0. No lump sum. Weekly contribution, $10. That is $520 per year. Investment, a diversified dividend ETF with an average yield of 4% and an average annual total return, dividends plus price growth, of approximately 8%. This is conservative. It is based on historical averages of established dividend ETFs. Past performance does not guarantee future results. Drip on. Count Roth IRA, no taxes on growth or dividends. Here is what happens. Of year 1, you have invested $520. With a 4% dividend yield and modest price growth, your portfolio is worth approximately $560. You have earned around $20 in dividends, all reinvested automatically. Does not feel exciting yet. That is normal. This is the bottom of the hill. End of year 3. Total invested, $1,560. Portfolio value, approximately $1,750. Annual dividends, around $70, all reinvested. Of year 5, total invested $2,600. Portfolio value, approximately $3,200. Annual dividends, around $128, all reinvested. Something is starting to happen. Your portfolio is now worth more than you put in, even without adding any extra money beyond your $10 a week. End of year 10. Total invested, $5,200. Portfolio value, approximately $8,500. Annual dividends, around $340 per year. That is $28 a month in completely passive income from $10 a week. Of year 20. Total invested, $10,400. Portfolio value, approximately $26,000. Annual dividends, over $1,000 per year. That is $83 a month in passive income from $10 a week from nothing. Here is the thing most people miss, and this is the open loop I planted at the start. The difference between someone who builds real wealth with $10 a week and someone who does not is not intelligence. It is not income. It is not market timing. It is one decision made consistently, thousands of times. The decision to not stop. Almost everyone starts. Very few people keep going through the months where it feels pointless, where the portfolio is small, where the dividends are 30 cents. People who keep going anyway, those are the ones the math rewards. Now let me show you 2 paths side by side. Path 1, $10 a week, Roth IRA dividend ETF, drip on, consistent for 20 years. Result, approximately $26,000, over $1,000 a year in passive income. Path 2, $10 a week, taxable account, dividends taken as cash and spent. Stops contributing for 6 months during year 4 because life gets busy. Never quite gets back to consistent. Result after 20 years, a fraction of path 1, maybe $6,000 or $8,000, almost no passive income. $10 a week, completely different outcome. The system is simple. The consistency is the hard part. The mistake, and this one is subtle. The mistake is tracking your portfolio value instead of tracking your behavior. Beginners open their brokerage app every week. They see the portfolio went up $3 or down $7. Feel good or bad based on that number, and eventually the emotional roller coaster makes them stop. Is the fix? Track your contributions, not your portfolio value. Every week your only job is to confirm that your $10 went in, that drip is still on, that your account is still open. I contribute this week, yes or no. That is the only number that matters in the early years. Your portfolio value will go up and down. Your contributions are entirely within your control. Focus on what you can control. Simple note on your phone works fine. Week 1, contributed. Week 2, contributed. Week 3, contributed. That streak is your real portfolio. Let me recap everything fast. Count choice determines how much of your compounding you keep. Roth IRA protects everything. Dividend ETFs with fractional shares let $10 go to work immediately. 3. Drip on means every dividend automatically accelerates your snowball. 4. Increasing your contribution over time is the most powerful lever you have. 5. Track your contributions, not your daily portfolio value. Consistency is the strategy. Action you can take today: open a Roth IRA, set up a $10 automatic weekly transfer, and turn on drip. That is the entire setup. It takes 20 minutes. Then your only job is to not stop. If this gave you a clearer picture of what is actually possible, subscribing takes 1 second, and it helps this channel keep going. That you have seen what $10 a week can build. The next question is, which specific ETF do you actually put that money into? In the next video, I break down the only 3 dividend ETFs beginners actually need, including which one I would start with today, why JEPI is misunderstood by most beginners, and the one account mistake that quietly costs investors hundreds of dollars every year. Click the next video on screen right now. I will see you there.